Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. I want to talk a little bit about Roth conversions this week, and we hear so much these days about the benefits of converting a traditional retirement account to a Roth, and many of us just take it for granted that it's the way to go. But there was a Market Watch story, and a columnist argued that the financial benefit is relatively small, and it'll take longer to think than you see any benefit from a Roth. So what's your take, Art McPherson, Luke McCarty, on Roth conversions?
So I'm going to simplify this for our listeners out there. The only way a Roth conversion doesn't work out in your favor is if taxes go down or if your tax bracket in retirement goes down significantly. So what we're seeing with clients is we feel taxes are going up, because the government's spending trillions of dollars. So we think that's in play. And a lot of times the perception of your taxable income going down in retirement isn't always the case, right? Because now you're off work, right? You're traveling, you're doing things you haven't done before, and you're actually maybe spending more money than you even did before. Of course, it depends how much you save before you get there. But we're seeing higher taxes, and we're seeing people even spend more money in retirement than they have while working.
Right. And so one of the scenarios is, and we have a lot of CPAs look at it this way, the cost of the conversion. So if you look at an IRA, and 95% of the money that is in a 401k is typically IRA dollars, because Roths are relatively new in modern history. So there's a lot of money that has been saved, just IRA money. Well, that money, when you pull it out, 100% of that is taxable, Mark. You cannot avoid it. You cannot not make it non-taxable. So if you're pulling money out, and you also have a pension, you have your Social Security, you add all that together, and all of a sudden you may be jumping brackets. Well, wouldn't it be nice to be able to have some non-taxable money or non-taxable resources that we could pull from that keeps you from jumping brackets, or that keeps you from having to have that Social Security as taxable income? Mm-hmm. So anything that we can do from a financial planning standpoint, it may not seem like it's really worth it on the conversion side one time if you just take the lump sum, how long it takes to recover. But what you also have to factor into that is going forward for the next 20 years. Would you like to have 20 years worth of retirement income tax free versus taxable? So those are the discussions we have. So making sure, and we have calculations we can put in the system, shows where our break-even points are on the conversion, and then also it shows them, if you did a Roth conversion, this is what your taxes are going to be now, right, and going forward over the next 30 years of retirement. Or now we've converted some money, this is what your tax bracket is going to be now, going for the next 30 years in retirement. So we can really dial in the details of the data.
Art, that's a really good point. So there is a break even on the calculation for you and your spouse, right? For you and your money, there's a break even. However, the break even for your beneficiaries is day one. So if you have assets that you think you may not need to spend in retirement and you're going to pass down to, your kids, well, do your kids want to inherit it and pay taxes on it at their tax bracket? Or do you have the ability now to pay taxes, do the conversion, and then your kids get it tax-free?
Art McPherson, you mentioned a second ago about pensions, and pensions are pretty much a thing of the past. I want you to hear this clip from Michael Finca from the American College of Financial Services, who told Yahoo Finance that's why younger generations are starting to take note of these so-called private pensions.
There was a recent study that found people in my generation, Generation X and millennials, were actually quite interested in this idea of taking a portion of their defined contribution savings and putting it into some kind of an instrument that provides an income for a lifetime. So you go to an insurance company and you provide them with a lump sum of money, and in return they offer you a lifetime guarantee of payments. It is essentially the equivalent of a private pension. And I think it's because we're really just entering the first generation of retirees that don't have pension income.
Okay, as we talk about, break that down for me again. Explain what a private pension is.
Well, basically, you're taking 401k assets or IRA assets that have no guarantees with them. Those monies rise and fall based on the economy, based on the stock market. So they're up and they're down and they're all over the place. So it's hard for people to understand or know, how much can I pull out and have this last for the rest of my life, and at the same time keep pace with inflation and not ever run out of money. So it's hard to really guarantee yourself that because the market's always up and it's down and it's all around. So one of the things you can do is you can take a percentage of that. So maybe 20% of your portfolio, 30% of your portfolio, and make sure you give it to an institution, which is typically the insurance side because that's what they do. And they'll guarantee you literally a lifetime income payments so that portion of the dollars, so if it's $2,000 a month, it'll come in the door like clockwork, just like your Social Security does. So a lot of people are looking for that because that's no longer available. Just like you said, it was a thing of the past to have these pensions. Luke and I typically will do those things for our clients, but we give them escape clauses so they don't have to take the money and give it to the insurance company. We want to make sure their beneficiaries also get the money. So we have riders and provisions like that we put on there to make sure that they can get the guaranteed income, but they're not tied into annuitization, things like that. That can be a negative thing for the family.
Right. So the Secure Act, came out and said, hey, 401k plans, you can now offer a pension, through an annuity. Mm-hmm. However, if you see that on your statement and, it may say this amount of money could provide this much income for life, be careful because that's the opposite of what Art was talking about. That's where you give all your money to the insurance companies. And if you pass away, it's gone. So you need to be very careful what type of instrument you use. We like those escape clauses Art was mentioning. We like death benefits for the beneficiaries. We don't necessarily want you to give away your money just so the insurance company will give it back to you.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174. 725.
Today's show has been a work of art.